When you walk into a really crowded restaurant, there's this very natural assumption we all tend to make.
Right, like if all the tables are full, they must be doing great.
Exactly. If the kitchen looks chaotic and the staff are just pushing out hundreds of orders an hour, we look at that flurry of activity and think, wow, this place is making an absolute killing.
Yeah, it is deeply ingrained in how we view business. I mean, high volume almost always signals financial success to the casual observer.
Right. But what if you peeked at the books and you found out they were only selling like $2 hot dogs?
Uh-huh.
And after paying for the meat, the buns, the staff, the rent on the building, they were actually only making a penny on each plate.
Wow. Yeah, you would quickly realize they're working incredibly hard just to tread water.
Right.
The sheer volume of transactions is creating this illusion of financial health, but the underlying mechanics are actually quite fragile.
Now imagine another restaurant right next door. It's quiet. The dining room only seats maybe 20 people a night. But they only serve $100 dry-aged steaks,
Right.
and their net profit on every single plate is $50.
I see where you're going with this.
Yeah, the first place has massive revenue, a huge top line, as they say in finance. The second place has much lower revenue, but the owner is the one driving a Ferrari.
Exactly.
Welcome to the deep dive, everyone. I am thrilled you could join us today because we're looking at a stack of financial documents that illustrates this exact dynamic, but on a massive, multi-billion-dollar corporate scale.
It's honestly a phenomenal case study in corporate strategy.
Mm-hmm.
Today, we're analyzing Booz Allen Hamilton's Q4 and full fiscal year 2026 earnings call presentation.
Right, the one dated May 22, 2026.
That's the one.
And the fundamental tension in these sources, the thing that made us realize we had to do this deep dive for you today, is a glaring paradox right at the top of their balance sheet.
It really jumps out at you.
It does. How does a massive company report a 6.4% drop in their annual revenue, but simultaneously celebrate strong profitability and double-digit earnings growth for the quarter?
Well, we're going to dissect the financial engineering, the market dynamics, and the strategic bets of a giant in the defense and technology sector.
Yeah.
The goal here is to give you a masterclass in how a massive government contractor navigates a highly complex market by leaning into high-margin technology.
Right, and why intentionally shedding billions of dollars in revenue might actually be a calculated masterstroke.
Exactly.
Okay, let's unpack this, because the raw numbers for fiscal year 2026 seem completely contradictory when you first look at them.
They really do.
Total revenue hit $11.2 billion. For a company of this size, that is a staggering number. But it is actually down 6.4% year over year.
Right.
If we zoom in just on Q4, revenue was $2.78 billion, which is also down 6.4% compared to the same quarter last year.
And typically, if a publicly traded company sees top-line revenue shrinking by over 6%, Wall Street hits the panic button.
Oh, absolutely.
Usually expect to hear frantic explanations about lost market share or operational failures.
But there is zero panic in this presentation. Instead, Q4 adjusted diluted earnings per share jumped 10.6% to 1.78.
Yeah, it's pretty wild.
And overall, FY26 adjusted EBITDA landed at $1.23 billion with a very healthy 11.0% margin.
Uh-huh.
Now, before we go further, these terms like adjusted EBITDA, adjusted earnings, they can sound like pure corporate jargon. When management uses the word adjusted, what are they actually asking investors to look at?
It is essentially management asking you to look past the accounting noise.
Okay.
Adjusted metrics strip out one-time events. So maybe a restructuring cost, a strange tax anomaly, or the cost of an acquisition. It's meant to show you the core recurring profitability of the business.
So they're basically saying ignore the weird one-off stuff.
Exactly. They are saying if you ignore the weird one-off events of this specific year, here is how the actual engine of the business is performing. And in Booz Allen's case, that core engine is generating a very strong 11% margin.
Which brings me back to the restaurant analogy. Did Booz Allen just stop serving the low-margin lunch specials to focus exclusively on the expensive steak dinners?
That's a great way to put it, yeah.
Because, how can a shrinking top line translate into a more profitable company?
What's fascinating here is how the company explicitly accounts for this in their reporting. They rely heavily on a specific metric called revenue, excluding billable expenses.
Okay.
For the fiscal year, that number was $7.8 billion.
Wait, let me make sure I have the math right. They reported $11.2 billion in total revenue, but only $7.8 billion when you exclude these billable expenses.
Correct.
That is a difference of $3.4 billion. What exactly makes up $3.5 billion of billable expenses?
In the world of government contracting, those are essentially pass-through costs.
Pass-through costs.
Yeah. When Booz Allen wins a massive IT modernization or defense contract, they are the prime contractor.
Hmm.
But they aren't just billing the government for their own internal consultants and software engineers. They're also billing for, like, the massive server racks they had to buy from a hardware vendor, or the travel costs for teams flying around the globe.
Oh, I see. Or maybe specialized niche subcontractors they had to hire.
Exactly, just to complete a specific piece of the project.
So Booz Allen manages the procurement of all those elements and then just passes the bill to the government.
You've got it. The money flows from the government to Booz Allen and then immediately out the door to the airline or the hardware vendor or the subcontractor.
And they book that as revenue.
They book that as top-line revenue, but they make little to no profit on it. It is empty calorie revenue.
Empty calories, I like that.
It inflates the top line, making the company look massive, but it mathematically drags down their overall profit margin percentage.
Right, because if you have a business doing $100 in high-margin consulting work and another $100 in zero-margin pass-through hardware sales, your overall profit margin looks terrible to Wall Street.
Exactly, even though the consulting side is thriving, which is why they are actively letting that pass-through revenue fall away. Yeah. When you strip away those low-margin expenses, you reveal the true profit generation capacity.
So it's intentional.
Completely.
Yeah.
Their jump in profitability isn't an accident. It is driven by incredibly disciplined cost management, lower tax rates, a reduced share count, and a purposeful focus on the work they actually perform themselves.
You know, if you are looking at your own business or even evaluating companies in your own investment portfolio, it is so easy to fall into the trap of thinking top-line revenue is the only metric that matters.
Oh, it's the most common trap there is.
But Booz Allen is proving that sometimes you have to shrink your revenue to actually grow your business. You have to cut the hot dogs to focus on the steak.
And if shedding billable expenses is their way of cleaning up the balance sheet, the obvious next question is, well, what are they actually keeping?
Right.
To understand why those margins are expanding so successfully, we have to look at the specific types of high-margin steak they are serving.
Yeah, if you are going to intentionally shrink, you need to make sure the remaining pieces are incredibly robust, which transitions us into the next major theme of the presentation.
The market bifurcation.
Yes. Management cites a very specific market bifurcation. They are basically dealing with a tale of two entirely different market environments. On one side, you have national security. On the other side, the civil sector.
The contrast in how they describe these two sectors tells you everything you need to know about global spending priorities right now.
So how do they describe national security?
It's highlighted as their robust growth driver. Specifically, they point to cyber and defense tech as their powerful growth vectors.
And the civil side. Things like modernizing IT for the Department of Transportation or health agencies.
The language there is much more cautious. They note that the civil sector is, quote, working through challenging comps, unquote, though they do believe it is gaining momentum.
Okay, when a company says they have challenging comps, meaning challenging comparisons to their past performance, it usually implies they had a massive spike in revenue previously that is now receding.
Right.
I'm guessing this is the hangover from the pandemic-era stimulus, like all those civil agencies suddenly had billions to upgrade their legacy IT systems a few years ago, and now that well is running dry.
That is a highly accurate read of the civil government landscape.
Okay.
The massive modernization funds have dried up, and civil spending is now subject to incredibly tight, complex budgetary constraints, not to mention political gridlock.
Sure.
But if we connect this to the bigger picture, the boom on the national security side makes perfect sense. We are living in an era of heightened geopolitical instability and relentless, sophisticated cyber threats targeting national infrastructure.
So it's an issue of elasticity.
Exactly.
If budgets get tight, a civil agency might delay upgrading their accounting software for another year. But the Department of Defense cannot simply choose to ignore a persistent nation-state cyber attack on its networks just because the budget is tight.
You nailed it. The national security side of the house is fueled by absolute existential necessity. Governments simply cannot afford to skimp on cybersecurity or advanced defense technologies.
Right.
These contracts are vital to national interests. And because the technical requirements are incredibly complex, they command premium, high-margin pricing.
So if the civil side is dealing with a post-stimulus hangover, but defense is booming, How do we know the overall trajectory of the company is still moving up?
Well, the presentation relies on a specific metric to prove their future health, the backlog.
Right. The backlog sits at $38.2 billion, which is up 3% year over year. But for those listening who don't follow government contracting, why is a backlog so heavily emphasized?
Because of how the U.S. government funds its operations.
Oh, okay.
The government works on congressional appropriation cycles. So, a company like Booz Allen might win a massive 5-year contract, but Congress only allocates the funds 1 year at a time.
I see.
So the backlog represents all the value of the contracts they have won, but haven't actually performed the work for or billed yet. It is a massive reservoir of future guaranteed revenue.
That makes sense. And the presentation pairs that $38.2 billion reservoir with another vital metric. They boast a robust last 12 months or LTM book-to-bill ratio of 1.1x.
That is arguably one of the cleanest indicators of future growth you can find in corporate finance.
Really? How so?
Well, the bill side of the ratio represents the work you have completed and invoiced the client for. The book side is the brand new contracts you have just signed.
So if your ratio is exactly 1.0, you are just treading water. You finish $1 of work, you sign a new $1 of work?
Yes, but a ratio of 1.1x means that for every $1 of work Booz Allen finishes and bills, they are booking $1.10 of new work. Their pipeline is growing 10% faster than they are depleting it. It is a clear mathematical signal that their high-margin cyber and defense services are in massive demand.
Okay, so they have a growing pipeline of new work. They are actively shedding low-margin pass-through contracts to focus on highly profitable defense tech, and it is translating into expanding 11% margins.
Exactly.
Here's where it gets really interesting, though. What happens to all the actual cash generated from this strategy?
Oh, it creates a tremendous amount of free cash flow.
Yeah, the cash engine described in these documents is remarkable. They generated $951 million in free cash flow for the fiscal year.
It's a huge number.
Just in Q4 alone, they brought in $212 million. The sources note this is driven by billing efficiencies and strong collections. Basically, they are getting much better at making sure the government pays its invoices promptly.
Right. And generating nearly $1 billion in free cash flow gives a company incredible optionality. It allows management to dictate their own future rather than being at the mercy of capital markets.
And the presentation lays out exactly how they deployed that capital over the fiscal year.
Yeah, they were very busy.
They put $234 million into strategic capital deployment, which we'll get to in a second, but they returned a massive $837 million to shareholders through dividends and stock buybacks. No, wait a second. Let's connect this back to what we discussed earlier. We talked about their earnings per share jumping 10.6%.
Right.
If they're spending hundreds of millions of dollars to buy back their own stock, they are reducing the total number of shares in existence.
Yeah.
Doesn't that mathematically inflate their earnings per share, even if the actual net income stays flat?
You've hit on the exact mechanism. Earnings per share is simply total profit divided by the number of shares.
Okay.
So if you shrink the denominator by buying back and retiring shares, the value of every remaining share goes up. They are manufacturing EPS growth.
Wow.
It is a very standard, highly effective way to keep Wall Street investors happy, but it requires a massive amount of excess cash to pull off.
So they are keeping today's investors happy with buybacks. But what about tomorrow's market? You mentioned the $234 million in strategic capital deployment.
That is where they are securing their future. They highlight that they have over $2.2 billion in substantial liquidity, and their net leverage ratio is sitting at 2.6x.
Which is pretty healthy, right?
Very healthy for a company with highly predictable government cash flows. They are using that war chest to make targeted acquisitions.
Yeah, if you read the fine print in the appendix of the presentation, they mention non-recoverable costs associated with an upcoming acquisition of a company called Defy Security.
Yes, closing in the first quarter of fiscal 2027.
So they're taking that massive liquidity and buying a specialized cyber firm to bolt directly onto that national security growth vector we discussed earlier.
Precisely. They aren't trying to build every cyber capability from scratch. They are using their cash flow to acquire established niche players that fit perfectly into the high-margin market demands of their defense clients.
Which perfectly sets up the final piece of the puzzle we need to look at, the horizon. Where does Booz Allen see itself going next year?
Always the most important question.
Because when I looked at the newly initiated fiscal year 2027 guidance in these documents, I immediately noticed a discrepancy that seemed incredibly contradictory.
The guidance numbers often hide the most interesting strategic realities. What stood out to you?
Well, they expect revenue to grow slightly, maybe 0 to 4%, hitting somewhere between 11.2 and 11.7 billion. And they expect margins to stay steady at around 11%.
Right. That all tracks.
But then I looked at their adjusted diluted earnings per share guidance. They are projecting 6.0 to 6.35 for FY27. But they just finished FY26 reporting an EPS of 6.51.
Yep.
If you just hit 6.51 and you're projecting 6.0 to 6.35 for next year, isn't that a massive step backward? How can management claim they have momentum if they are projecting their earnings to drop?
It's a highly counterintuitive set of numbers until you look at a specific slide in the presentation called the FY27 ADPS bridge.
Okay, the bridge.
It's the bridge connecting last year's reality to next year's expectations.
Yeah.
You have to understand that the 6.51 figure for FY26 wasn't just pure operational profit generated from consulting.
Right.
It was artificially inflated by two major one-time accounting events that will not repeat next year.
Okay, let me guess how this works based on our conversation about adjusted metrics earlier. They must have had some lucky windfalls in FY26, and they're essentially telling investors, don't grade us on the windfalls, grade us on the actual consulting work.
That is exactly the dynamic.
So what were the windfalls?
The presentation breaks down two specific ones. First, they had a 50-cent non-recurring research and development tax credit benefit.
50 cents per share, that's huge.
It is. R&D credits are fantastic incentives, but they are often lumpy and unpredictable based on when the IRS finalizes them. You cannot build a recurring growth strategy around hoping the IRS hands you a massive credit every single year.
No, definitely not. And the second windfall?
An 11-cent unrealized gain on venture investments. Booz Allen has a corporate venture capital arm that invests in tech startups.
Okay.
If one of those startups raises a new round of funding at a higher valuation, Booz Allen has to mark up the value of their stake on their balance sheet.
Ah.
It makes their earnings look fantastic, but it is purely paper wealth. It isn't cash generated from their core defense consulting operations.
So if we do the math here, you take the reported 6.51, you subtract the 50-cent tax credit anomaly, and you subtract the 11-cent paper investment gain.
Right.
You are left with 5.90.
Yes, that 5.90 is the true operational baseline for fiscal year 2026.
Wow. Which changes the entire narrative for anyone evaluating the company.
Absolutely.
When Booz Allen targets 6.00 to 6.35 for next year, they aren't projecting a decline from 6.51. They are projecting solid organic year-over-year growth from that true baseline of 5.9.
Exactly.
It is actually a 2% to 8% growth target on their core business.
It perfectly illustrates why you have to look past the headline numbers. You have to strip away the tax anomalies, the paper gains, and the empty calorie pass-through revenue to see how the actual engine of the business is running.
Yeah.
And their underlying engine is incredibly healthy.
But as we wrap up, there is one final detail in those FY27 assumptions that I just couldn't shake.
Oh, what's that?
We have spent this entire deep dive exploring how this company is dominating the digital invisible realm. They are focused on cybersecurity, digital defense tech, and virtual networks.
Right.
But when you look at their planned capital expenditures, the actual cash they plan to spend on physical assets next year, it's budgeted at $220 million.
It's a lot of hardware.
And nearly half of it, $105 million, is going toward building a brand new physical headquarters.
It is a fascinating data point to uncover at the very end of a deeply digital growth strategy.
It seems like a massive contradiction to me. What does that kind of physical footprint imply for a company whose entire growth thesis relies on defending virtual architecture?
It's a great question.
I mean, why build a monolithic office space when your ultimate product is code and strategy? We've seen how they mastered the financials by dropping the real-world billable expenses to focus on high-margin virtual solutions, hoarding a $2.2 billion liquidity war chest in the process.
This raises an important question.
Yeah.
If a premier defense and cyber tech company is projecting its strongest, most lucrative growth in the digital realms, what does it truly mean that their biggest single capital expense next year is a $105 million physical headquarters?
Right.
As warfare, government operations, and even corporate workforces become increasingly decentralized and virtual, is the ultimate flex of a successful technology contractor still a massive physical monolith of a building?
It's wild to think about.
Does proving you master the invisible digital world still require planting a $100 million flag in the physical one?
That is a fascinating paradox to leave hanging. It forces you to completely rethink what corporate dominance looks like in a digital age.
It really does.
Well, thank you all for joining us on this deep dive into the hidden mechanics of corporate finance, the realities of defense contracting, and the strategy behind the numbers. Keep looking beneath the surface, and we will catch you next time.